We now progress to the second unit of wealth management, and in this particular unit we're going to look at the introduction to the various kinds of investments and asset classes. We're going to look at what kind of instruments are available through which people could save their money and also invest their money. So we're going to primarily divide this into two parts. We're going to look at what are the various saving instruments available, and then we're going to look at what are the various investment instruments available, and we're going to look at what is the difference between let's say a savings instrument and an investment instrument. uh, this is going to be in the context of largely what kind of instruments are available in India and what kind of numbers we have seen in India with respect to these data points, right? So now the first part on why someone would want to kind of need investments or saving is that people have to address a few concerns, and those concerns are primarily how do you beat inflation, which is essentially the rise in prices every year, right? So unless your money grows every year, the price rise is going to eat away into the purchasing power of your money. And to beat inflation, you need your money to also grow at a certain rate. So for example, if you are buying something worth 100 today and next year you're going to pay 104 for that, you need your money also to grow at least 4% so that you have 104 and you can buy the stuff, correct? So this is the product you are trying to buy, and this is the money that you have, and so the growth rate in money has to be at least equivalent to the inflation rate, surely, right? How do you increase your capital? Now people may want to maximize wealth, right? Everyone wants to earn more money, so maximizing wealth is an objective for which you will need investments. How do you manage a variety of your goals? Goals could be further education, goals could be education for kids, goals could be vacation, goals could be retirement planning. So there are a variety of goals which would be available. How do you ensure that you have enough money for all these goals, right? So to address these primary concerns and these primary data points is why someone would essentially go for either a saving instrument or an investment instrument, right? Now we're going to broadly look at what is going to be the difference between the instruments which are used for savings for anyone and the instruments which are used primarily as investments for someone, right? Now what's the difference between saving and investing? So primarily saving is for contingency. Essentially you're trying to mitigate risk. You're trying to save for a time when you might suddenly need that money. So for these contingencies is why you're going to save. Your primary objective is capital preservation, protection of the capital. You do not want to lose capital, right? That's the primary objective. If I have money in my bank account, I think it is safe because it's secure in the bank account. I don't have to carry it physically everywhere, and that's why saving is primarily going to look at what is called as capital preservation. And by consequence, because I'm looking at capital preservation, the risk is usually lesser, right? Now savings also comes first before investing, usually. That's the usual connotation. So someone gets an income. Out of the income you subtract any kind of expenses, then you have some money that is left in your account. That's automatically a saving, and from the saving you could divert some stuff towards investments. Now what is the difference between savings and investments? From the investment perspective, when you're doing investing, primary objective is that you want to grow capital. You want capital appreciation, right? Now, and because you're going to grow capital, or that becomes your objective, the risk that you're taking would usually have to be more, right? So risky. Investing is typically riskier than your savings instruments that are available, right? And that's the primary difference. For contingency, for sudden emergency requirements, so for emergency requirements, you want savings. For planned requirements in future, you want investments. That's the difference. That's a broad difference. So if something is in the future, 3 years, 4 years, 5 years, 10 years down the line, you'll probably use investments to take care of that. If something is sudden, you don't know when it is coming, for that you would use your savings, right? Now remember, there's a thin line between the two. It is not to say that people cannot, so for example your retirement is in the future, it is not to say that savings cannot be used for retirements. The reason you keep savings is because emergency might come in, but if there is no emergency, the saving could then be used as investing automatically because that money is still there, right? So just remember this bit, that while there is a broad difference in terms of what's the objective with saving and investing, in your mind, technically they could be interchangeable in the context of when the money gets used. You could use the saving money for the goals that you had in mind for investing, right? So there's no hard and fast rule that saving money has to be used only for emergency. So that's saving and investment. Now, broadly, the kinds of instruments that are available for savings or people typically use for savings are primarily going to be banking instruments, or they are going to be post office instruments, or they are going to be some sort of a government fund, right? These are the three categories. So for example, you could have a savings account, you could have a current account, you could have a fixed deposit, you could have a recurring deposit. Then you could have an employee provident fund, you could have a public provident fund, and then you could have post office savings schemes and others. These are all schemes that are available in India, right? On the investment side, however, you would either have something to do with the stock market, so stock market linked products. You could have something to do with debt or what is commonly known as bonds. You could have real estate. You could buy a piece of land or buy an apartment or buy commercial real estate that could come in. You could have commodities such as gold, silver. Sometimes people buy base metals such as copper, etc. People also trade in agri commodities a lot of the times. And you could have alternatives. Alternatives are anything that does not fall in the top bracket. That could be things like derivatives. That could be things like art, wine. You would be surprised to know that people actually collect paintings. There is an investment that is done in paintings. People collect wine. Investments are done in wine. And essentially at a later point of time, the wine gets sold at probably a higher price point, right? So these are all the primary investment instruments. We'll be most concerned about the top four. Alternatives would probably go beyond the scope at this point of time. Within the top four as well, the most of our time would stick to stock market and debt for all practical purposes, right? Let's first look at what kind of savings instruments are available and what is the primary difference between these instruments that are available with us, right? So let's take a look at the savings instrument. We've looked at the names of these, which is savings account, current account, fixed deposit, recurring deposit, also known as RD or FD. Then we have EPF, Employee Provident Fund. We have PPF, which is Public Provident Fund. We also have a Voluntary Provident Fund that's called VPF, but that's similar to these. And then we have post office schemes, which would be there, right? Let's look at these one by one. So the first context that comes is current account. Now, current account typically is usually opened for corporates or companies, right? But individuals could open it in the capacity as a proprietor or a consultant. The idea is it's intended for day-to-day transaction. There is no interest paid by banks. It's the cheapest source of funds from banks. So banks want you to open current account. Technically, the requirement of current account is from the perspective of cash management. If you deposit money and you immediately want to take that money out, that's where current accounts are useful, right? And typically that's why companies have current accounts. Companies are not allowed to open savings account under their name. So effectively this gives you 0% interest. That's the first instrument. It's technically a saving instrument, but it does not give you any kind of increase in your capital. right? So in a sense, it will not safeguard you against your inflationary problems, right? The next one comes what is called as a savings account, which is the generic account that all of us have in our bank, right? That's the generic bank account that all of us have. It's a savings account. Typically, the interest that is paid is 4 to 6% per year, and that's paid by the banks on this money. So if you invest 10,000 rupees in a bank account, most likely the amount you will get would be 10,400 to 10,600 depending on what banks you are investing in at the end of the year, right? It is intended for savings which may eventually become investment, and you can also create an emergency fund, right? Now, how much is a good emergency fund? So typically what is said is that your expenses worth 3 months should be there in your savings account. So if you have a household that spends about, let's say, 30,000 a month, then the minimum amount you should have in your savings account is 90,000, right? And why is this necessary? Because there could be any kind of contingency. God forbid, if there is some sort of a medical requirement in the family and someone gets admitted and you suddenly need money, then you need the primary objective of these segments is that they provide quick liquidity. These are what are called as demand liabilities in the banking system. Why? Because you can go to the bank and demand this money whenever you want. Savings accounts are the second cheapest source of funds for the banks, right? So when you walk into a bank, if someone works in a bank, banks have a lot of objective of opening what is called as CASA, current account, saving account, right? So current account is CA and saving account is SA, combined is CASA. The more the CASA for a bank, the lower cost of funds. They have to pay lower interest on the money they have raised. So if you work in a bank, you'll typically get a mandate where a lot of CASA accounts have to be opened by the banks. If you're an investor who's trying to save money, then current account is typically for corporate, savings account is typically for individuals. Generic accounts that we have in our banks are savings accounts, right? Then we move to the other common form of instruments, which are fixed deposits. Typically from your savings or current account, you could put money in terms of term deposits, right? You could fix the tenure and basically you are blocking money for that tenure. When you block money for that tenure, the bank is willing to give you a higher interest rate. Within this, senior citizens in India, which is greater than 60 years of age, fetch higher return, usually 25 basis points higher. What does this mean? That if someone does a 5-year FD and the rate on that is 7%, then if a senior citizen does the same thing, the rate would be 7.25%. That's a benefit the government of India gives to senior citizens, right? Tenure of fixed deposits ranges usually from a week to 10 days. It could be less than a week as well, but you really don't get any meaningful interest in that context. And when you get your interest payment, let's say you put in 1 lakh rupees in your fixed deposit, you're going to get 1,08,000, let's say, assuming 8% interest. Now, if your income goes above a certain limit, right? If your income goes above a certain limit, the bank will cut TDS and give that to you. If you don't want that, TDS is tax deducted at source, so the bank assumes that this is your income and you will be paying certain tax on your income, right? If you want to avail a benefit on that, there's something called as Form 15G or 15H, which can be submitted to the bank, in which case the bank will not cut TDS for you, right? More on this when we talk about taxation as to what is the requirement, right? Then we have something called as recurring deposits, which is nothing but primarily smaller fixed deposits kept being made every month, right? So essentially every month you're trying to make small fixed deposits. Rather than depositing 1 lakh in a direct shot, you're trying to do 10,000 across 10 months. It's like a good EMI. Why is it a good EMI? Is because it is saving money for you. Interest rate structure is similar to the FDs, and tenure can be defined by the account holder. For how long do you want to keep doing this recurring deposit. Let's say I want to do it every month for 2 years and you want to do it every month for 4 years. Both of those are allowed. We could do any one of those, right? So that's the fixed deposit and recurring deposit. Next, we move on to a couple of mandated instruments, and primary objective of these when the government created them was retirement savings for the purpose of retirement of common masses, right? So employee provident fund is started to promote savings from retirement perspective. The When you get a salary, the compulsory contribution of 12% is by employee, another 12% is given by your employer, right? So effectively what you contribute, your employer also contributes. If you're working in multiple companies, you will end up having multiple EPF accounts because each company will have an EPF account for you, right? You can now link all of them using what is called as a universal account number. Earlier, till about 10 years back, 5 years back, you had to transfer your PPF account. Otherwise, if I worked in company A for 5 years, my EPF account would be lying there. And then when I change my job, another EPF account would be opened. So either I transfer the money or I let it lie there where it is. Now, if you let it lie where it is, it stops earning interest beyond a point, right? So you want to try and either transfer that money. Now you can link all these EPF accounts using what is called as a universal account number. So every time there's a EPF account open, you get a universal account number and you can link all your accounts under that. Current interest rate is 8.75%. The government keeps defining it year on year. Currently the rate is 8.75% as defined by the government, right? There are rules with respect to withdrawals here, right? There are restrictions and rules with respect to withdrawals. We don't need to remember all of them, but just remember that we can't take out all this money in one shot whenever we like. That's not allowed. Same is the case with PPF. The objective of Public Provident Fund was also retirement. It can be opened by any Indian, but this is a long-term instrument. This is a long-term saving. Why? Because the minimum tenure is 15 years and then you can extend it after that as well in blocks of 5 years. It's typically a debt instrument directed towards investment. So when you give money to the PPF will on your behalf, or EPF on your behalf, will go and buy some bonds. That's how they give you the interest, right? So the agency who would be managing the employee provident fund or public provident fund would then go and buy debt instruments largely. Now, because the tenure is 15 years, the liquidity is not high, you cannot get your money back quickly. You though have a facility that loan can be availed against the amount in PPF. So if you have 10 lakh rupees in your PPF, you cannot withdraw it unless 15 years are done, but you can take a loan against it, right? Tax is exempted on withdrawal. So whatever money comes out with interest component of 8.1% after 15 years, you will not pay any taxes on that, right? So that's your public provident fund and employee provident fund. There are a few other instruments which are available, which are typically, for example, post offices in India historically, traditionally have given investment avenues, and that's because post offices, the reach was significant. Right, so primarily because of the reach and network of post offices in every village, every rural area, also there is a post office. So it's easier for someone to kind of go and put money there. So post office time deposits are for those who want to put money for a fixed period. That's effectively like an FD, a bank FD. But let's say you don't have a bank account, then post office FD or time deposit is useful. The interest rate ranges between 7.1 to 7.9% depending on what is the tenure selected. Similar to a bank recurring deposit, you have a post office recurring deposit. It's a tenure of 5 years. You can keep depositing every month. Interest rate 7.4% today. This can keep changing. Then you have something called as National Savings Certificate. It works like an FD, but tenure of 5 years, interest rate 8.1%. There are subtle differences between all these instruments in terms of what kind of taxation implication they have. But broadly, they kind of come all under the saving bracket itself, right? Recently, the government has also launched what is called a Sukanya Samriddhi scheme. If you have a daughter, it can be opened in the name of that girl child. Interest rate is 8.6%. and you can put in money, and when the girl child turns 21, then the money is given to the girl child essentially, right? So that's the idea of a Sukanya Samriddhi scheme. There are again some sort of tax benefits that are given in order to encourage saving money for the education of the girl child, right? So essentially that's the broad idea in terms of how the government is trying to propagate savings. These are primarily the major savings instruments that are available, right? That's broadly it in this particular section. As we close our video, let's quickly answer these two questions. What are the various kinds of savings instruments which are available? Explain the difference between employee provident fund and public provident fund.